Hi, my name is Jerry Yu and welcome to my YouTube channel. Today we're going to be talking about the important role of life insurance in estate planning. Many of you out there have done a tremendous job growing and accumulating wealth within your estate. But what if I told you that if you passed away, the government could come in and take half of your estate in the form of estate taxes? You probably wouldn't feel too good. But what if I told you that there is a simple solution by simply taking a portion of your asset today and purchase a life insurance policy to leverage that risk? See, when you passed away, that life insurance policy can pay for your estate taxes while keeping your estate completely intact. Unless you love IRS so much, you never wanted to have to pay any additional taxes if you don't need to. What most people want to do is be able to transfer that wealth in the most tax-efficient way possible. If we can do that by using stock or bond or mutual fund, we will absolutely do that. But those financial vehicles cannot do it. It's just that life insurance is one of those vehicles that allow us to do it in the most tax-efficient way possible. So life insurance oftentimes has been called the Swiss Army knife of estate planning because it provides so many different functions that other financial instruments simply cannot solve. Before we get into life insurance, let's talk about one key component that should be included in every estate planning. That is a living trust. A living trust is an agreement that you will be able to set forth by creating an entity that allows your wants and wishes to be executed at the time you pass away. There are many benefits, but we're just going to go over a few, and that is keeping your estate private and under your control by protecting your family and leaving a lasting legacy. And to help avoiding probate by keeping it private and under your control with a living trust, it allows you to control that what happened to you or your estate when you are no longer here. Unfortunately, if you are forced to go through probate, that whole process is completely public. By creating a living trust that keeps your estate private within the family or whomever is part of your estate. Next is being able to protect your family and leaving that lasting legacy. Losing a loved one is never easy. With this stress, it can bring out the worst in people. See, by setting forth the trust and the rules and regulation of your estate, there isn't anything to bicker about because you have already made the decision on how your estate will be handled. Lastly, avoiding probate. Probate is simply the process, the government managing your estate. There are a lot of moving parts. See, there are court fees and executors, and there are creditors that all needs to be paid prior to beneficiaries taking over your estate. Oftentimes, this process can be lengthy and costly. And it can take anywhere between 18 months to 3 years sometime, depends on the complexity of your estate. See, having a living trust set in place can help expedite the transfer of wealth and ultimately give you the control either you're alive or in the grave. Next, we're going to get into life insurance. Before we do that, I do want to talk about some of the estate taxes and what is called inheritance tax. It's no surprise to any of you that the taxes are going up. If you ask most financial professionals, they will tell you that we are at an incredibly low tax rate right now, even though sometimes it doesn't feel that way. But on top of that, the estate tax has changed over the years. One area that this administration has talked about is estate tax. See, if you are assuming tax will go up in the future, then we need to be mindful of how that's going to ultimately affect our estate down the road. If you have ever lost a loved one, most likely a parent, and you are overseeing their estate, then you are familiar with IRS 706 form. See, this is a form that's required for any beneficiary of the estate to basically itemize every single thing that comprises of that estate. Basically all the way down to your last pair of shoes. See, what happened is that you submit that form and anything that's over the estate tax exclusion, it's subject to estate tax. And the rate can be as high as 40%. And lastly, there is tax legislation. See, this is something that we know that tax will most likely be going up. The reason why estate taxes are a place that legislators are going after is because you cannot complain when you are no longer here. It's an easy way for government to collect revenue. And lastly, we're going to be talking about how to protect, preserve, and grow your estate. See, one of my most favorite vehicles to do this is by using a max-funded index universal life insurance policy. The contribution that you make into index universal life policy are credited based on how the market performs. The great thing about this is that if the market takes a tank, your policy does not suffer. You simply are credited as a zero for that year. But however, if the market does well, your policy will get credited, get positive credit, and we have typically seen anywhere between 5% to 8% year after year. In some years, we have seen return as high as 10 or 15%. See, as your policy is then credited year after year, that cash value grows tax deferred. And then ultimately, you have that income tax-free death benefit. See, with properly designed index universal life policy, like I have mentioned earlier, it's like a Swiss Army knife with multiple functionalities. You can use it to provide tax-free retirement income supplement or plan for your children or grandchildren's college tuition and does not impact their financial aids. Or you can focus on death benefit to provide legacy for future generations. See, I will leave you with a quote from my Uncle Gary. He told me that there are only two things that are certain in life. One, eventually we're all going to pass away. And two, there's always going to be taxes to be paid. See, the choice you make today will ultimately affect the generations to come. Do you want to pass on the estate liability burden after you're gone and have beneficiaries to liquidate your estate to pay estate taxes? Or would you rather take a portion of your asset today and pay 10 cents on the dollar to purchase a life insurance policy so that life insurance policy can pay for those estate taxes while leaving your entire estate completely intact for future generations? See, the choice is ultimately yours. And I want to thank you for watching, and we will see you next time. Thank you.